Hi, everybody. Jim Kruzan here for the October review. As we do every month, we give you a little bit of an idea as to how the market ended and see if there's any trends or any important information. To a large degree, we spend a bit of our time talking about the economy. We're not going to do that this month simply because the government, as we're recording, is still shut down, and the vast amounts of economic data that typically come out that we can analyze just hasn't. So most of the data we're looking at are at least a month or so old. So we'll just skip all of that. One thing that we've been concerned about for better part of 2 years now is at some point this economic data is going to do something. It's either going to show us that we are entering a recession. A lot of the data has been negative for quite some time, or the data will start to turn back around and it will show us effectively a soft landing. In either case, we would hope that the market broadens out somewhat. So we'll kind of look at the data for the month of October through that lens and see if we see any signs of things broadening out, or whether for the month at least things have continued to be somewhat concentrated. I started out by saying we're not going to talk about economic data. And part of the reason is it's old. This is the most recent data we have on the leading economic index. One of the reasons we've remained cautious. And through September, reporting out August, the data continued to look negative. We've missed one and soon to be two reporting periods. So we'll get back to the economic data once all the data kind of trues up and we get a better sense for where we are. One thing that we can still talk about is these extreme valuations that we have. It's kind of a double-edged sword, a double whammy, if you will. Economic data that looks questionable and very high valuations. Very little margin for error. One way of looking at valuation is to look at it through the lens of the Buffett indicator. This data is through June 30th, and it showed that the indicator was 217%. A long-term average is more like 70%. This indicates an extreme valuation. If we brought the Buffett indicator up current through the end of last week, we would see that the indicator now is 224%, the highest ever recorded. And whenever we get to these high extremes, there is ultimately a comeuppance. At some point, these valuations come down significantly. So this is an extreme. Another way of looking at valuation beyond this, the Buffett indicator, is to look at something called the Shiller PE ratio, or the Shiller index. It too looks at valuation. It's inflation adjusted, so values today can be compared to values decades ago. Earnings are smoothed out over a 10-year cycle. So we're not looking at shenanigans in a year or two, capitalizing expenditures to show higher than anticipated profits. The highest Shiller index ever was December of 1999, just before the dot-com bubble, and it peaked at 44. Today, we have the second highest reading ever at just over 40. By the way, that's much higher than it was going into the Great Financial Crisis. It's also much higher than it was going into the Great Depression. So these valuations are extreme. So again, a reason to be somewhat cautious and certainly not over our skis. But let's get into the month and see actually what transpired. So here are the returns through October and also year to date. And in some cases, there's a bit of a tale of two cities. The yearly numbers certainly are much better than the monthly. And in some cases, you'll see a reversal of trend. The S&P was up over 2% for the month, up 16% for the year. And part of the reason for that is the NASDAQ. A lot of those big tech stocks were up nearly 5% for the month and well in excess of up 20% for the year. An equally weighted S&P, same stock, just eliminating the cap weightedness of that index, was actually slightly negative on the month and up just single digits for the year. A value slant, high dividend growing securities, also a bit negative for the month and up almost 10% year to date. And bonds were pretty flat. And that's kind of interesting considering the fact that there was a rate cut. Bonds are giving the rate cut somewhat of a yawn, especially longer duration bonds. Still worried about inflation. Again, a number that we really can't get a handle on because we're not seeing a whole lot of government data. One thing that we also look at is what would a balanced, a 60-40 S&P to AG average would look like? And also, what would an equally weight average look like where we're not skewed to these extremes because of the Mag 7? And in the one case, looking at the S&P, it was up about 1.4%. That is a balanced portfolio, and up a little over 11 for the year. And an equally weight version of the same balanced portfolio would have been down fractionally for the month and would have been up about 6% year to date. Big difference in valuation in performance because of this big tech skew. And now let's talk about the Magnificent Seven and their participation in all of this. Throughout the year, and actually for the last several years, the Mag 7 has really contributed a lot of the stellar performance of the broad-based market. Looking outside of the S&P or the Mag 7, returns are, let's say, different, and in many cases, much, much less. So let's look at the Mag 7's contribution for the month of October and for the year. So what I do, as I've been doing, is I'll look at the actual weighting concentration of those individual stocks. And right now, those 7 represent 35.6% of the S&P. Imagine that. 7 stocks contribute 35.7% of its size or cap weighting. The top 10 names, 41.5%. That's a significant concentration, especially if we consider back to 2000, which was clearly a bubble, clearly a concentrated market, and the 10 largest names represented just about 20% of the index. So the inflation that we're talking about is 2x. Anyway, for the month of October, those 7 stocks, if we took their individual stock performance multiplied by their individual S&P weighting, contributed 2.6% to the index. The index was up 2.2, which goes to reason, as we just learned, that the equal weight index value stocks were flat to negative for the month. So this provided better return than the broad-based index. So we didn't get much participation in things outside of tech. For the year, it's a little bit different. We're getting other participation, not to the same extent, but participation nonetheless. And when you look at year-to-date concentration, the Mag 7 represented about 9.5% of the 16+% return that the S&P has had. So still pretty significant. So that trend of concentration continues, at least for the month of October. We'll see what happens when data starts flowing again. We'll see what happens for the month of November. And until then, take care. We'll talk to you soon.